So as we sit here today, ETF assets now at $13.2 trillion. That represents 37% of combined mutual fund and ETF assets. And that figure has been going up and up and up.
All right, joining me will be Ben Johnson, Head of Client Solutions at Morningstar, who, of course, is a leading provider of independent investment research, ratings, financial data, portfolio tools. They really do it all to help support investors and financial professionals. And Ben himself, this is someone who I always say is one of the best in the business covering ETFs. He's been doing this a long time. He's absolutely in the pantheon of ETF nerds. And I'll tell you right now, this is one of my favorite episodes I do every year, because if you don't know, Ben has actually been joining me for 8 years running now to recap the year in ETFs and look ahead to the upcoming year. And that's exactly what we'll be doing this week. You're going to get to hear Ben's top ETF stories from 2025, his favorite new ETF this year. You'll find out his ETF Issuer of the year. We'll certainly get into ETF flows. We have a bunch of topics for you. And again, we'll also look ahead to 2026 as well. And the good news for you is, after having Ben do this episode for the past 7 years, I have finally learned my lesson and decided to give him the full hour or so, because we always come up short on time. And so you're going to get the full hour of Ben and I. And hopefully you'll also get a full tour through the world of ETFs in 2025. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now bring in Morningstar's Ben Johnson, who is joining me from Chicago. Ben, it is always so great having you on here. How have you been?
I've been well, Nate, and thanks for having me on again. I love keeping this tradition alive. And there's plenty, as always, under the tree for us to unwrap today. So looking forward to digging in with you.
I like that. I was thinking, you know how they do Spotify wrap? This is like ETF wrapped to end the year. The other thing, too, I was thinking about this. So I know you're obviously a Chicago Bears fan. So we've been doing this episode long enough to see the beginning and end of the Kansas City Chiefs dynasty, which you know is my team, and now to see your Chicago Bears actually become a playoff contender. I think that tells everybody how long we've been doing this.
Yeah, it's kind of odd these days, Nate, to be in the city of Chicago. Don't get me wrong, the energy is absolutely just electric. But I think many in Chicago would agree that Ben Johnson, the Bears' new head coach, is probably the best thing to happen to the city in I don't know how many years. So I have yet to leverage my shared name with our new head coach, to get me a nice table at a restaurant or anything. I'll have to figure out a way to take advantage. But I've been absolutely loving it after a near 40-year drought for my beloved Bears.
Well, I am happy for you after going through the Chiefs' little mini dynasty over the past several years. It's so much fun. The town's buzzing. And so hopefully you will get, people will see your name and you'll get meals comp and all that. You can just play it up. But okay, let's dive into ETFs. And as I mentioned, we do have a bunch of topics to get to. And I think we typically start bigger picture. And so let's do that this year as well. And we'll see where that takes us. But let me first tee up a few stats for you and just get your initial reaction. And I know you're well aware of these stats, but let me rattle them off. And so as we sit here today, we've had record inflows into ETFs, nearly $1.4 trillion. We've had a record number of new launches. So I show close to 1,100 new ETFs this year. And then we've also had record ETF trading volume, which I'm sure you've seen this. Bloomberg's Eric Balchunas is calling this the ETF Triple Crown, which I thought was pretty good. I don't know where he comes up with this stuff, but give us your big picture take here. Like, how impressive has this year been for ETFs?
Yeah, very impressive in many regards, Nate, but also just a continuation of some long-standing trends that we've seen. So as we sit here today, ETF assets now at $13.2 trillion. That represents 37% of combined mutual fund and ETF assets. And that figure has been going up and up and up. So we are not all that far removed in all likelihood from the moment whereby ETF assets are actually going to potentially exceed mutual fund assets. You talked about launches and the record pace of launches. And granted, in that number, which is now nearing 1,100, there's a long left tail of what I will politely call dumb funds. And we can get into more detail on that in a bit. But nonetheless, we are on a pace whereby the number of ETFs will actually probably eclipse the number of mutual funds at the current rate sometime in early 2027. So it's really been interesting just to watch the continued growth of the space, the continued growth driven largely organically, largely by all form of investors, from very large institutions to advisors to individuals that are gravitating to the ETF package as just being a better way to consume all sorts of different investment strategies, be they active ones, index ones, something somewhere in between, or a whole host of new and novel exposures that maybe had been delivered via other means historically, but are now being wrapped in a single ticker for the sake of largely convenience and compatibility with the way that investors prefer to build portfolios to invest in markets today.
How big of a role do you think the market environment has played in some of these records? I would say particularly the inflow record, but also new launches. I think you could wrap in there because, let's look back over the past several years. You've had the S&P 500 up something like 26% in 2023, 25% in 2024. We're up about 17% this year. Do you have any sense as to how much that's positively impacted ETF demand overall, or again, even new launches?
Yeah, a benign market environment, Nate, never hurts. But what I would say is if you look back now at the nearly 33 years that ETFs have been around in the US market, ETFs have been growing rain or shine. In some cases, we've seen their growth actually accelerate in tougher market conditions. So if you look at the global financial crisis, if you look at the first quarter of 2020 and the COVID crisis, there have been tough times that have actually accelerated the ETF growth story. So not surprising that they've continued to grow. We've seen record dollar amounts flow into ETFs in 2025 in light of what has, again, been a very favorable market environment, save for that brief hiccup around April. So not at all surprised. And if anything, again, just a continuation of a trend whereby this is a secular growth story that has defied market cycles over the course of 3+ decades.
To your point on ETFs taking in new money, what is it? Neither rain nor shine nor gloom and night, or I'm sure I'm butchering the quote there, but we have seen plenty of situations where when there is a big market downturn, that actually is a boon for ETFs coming out of that. And I just rattled off how positive the market environment has been over the past several years. And so my question for you is, can we look at this the other way and say that perhaps the stock market has helped to keep money in mutual funds and some other vehicles, just because if performance is pretty good overall, even if there's some underperformance there, investors are looking at their statement and going, hey, I'm up, I feel pretty good overall. And maybe, they don't want to switch some of those vehicles because potential capital gains taxes. And so that leads to them being less likely to switch vehicles overall. Is that plausible? And where I'm heading, Ben, and we'll talk about 2026, but some people are saying, well, maybe 2026 isn't going to be a great year in the markets. And I'm not into those prognostications, but then what does that mean for ETFs? And I'm wondering if you can actually say, well, that may be very positive for ETFs, because you'll have investors looking at these mutual funds and saying, you know what, the same story we've talked about for a couple decades now. I'm going to lower my fees. I'm going to get into a more tax efficient vehicle. And you don't have that tax padlock on the funds, if that makes sense.
Yeah, I mean, I think if I were to distill everything you've described down into one word, Nate, it would be inertia. And certainly buoyant markets create more inertia on behalf of investors. It's not necessarily going to create any compelling events, any opportunities, any economic incentives for them to simply hop from one vehicle to another. And that's because if markets are doing well, if performance is good enough, I'm perfectly happy to sit still. And then I think more meaningfully, economically, there's that tax overhang, that tax inertia. If I've got embedded gains that I'm going to have to realize to switch from one strategy to another, one fund type to another, mutual funds to ETFs, the likelihood of me doing that is hopefully near zero, because it's just from an economic point of view an irrational decision. Now, when those overhangs begin to disappear, we saw moments such as in 2022 in the fixed income space, whereby the drawdown in bond markets led to at least a diminishment of that tax overhang, if not in some cases maybe it went away entirely. And what you saw was a mass exodus from fixed income mutual funds in that moment, and increasingly a switch over to fixed income ETFs, which is another key secular trend that continued and indeed accelerated this year. So investors are going to pick their moments whereby that inertia, that force that's keeping them to sit tight, and oftentimes rightly so, goes away, and then they can make that switch. And certainly that, I think, applies more so to where they've got money parked today. And separate from that, I think on the margin where the new money is going is very clear. That mutual funds oftentimes, especially in the context of just traditional IRAs or taxable accounts, most notably, are going to be the default choice, especially if you look at and begin to go down from generation to generation. And I think if you've ever seen now the decade plus long survey that Schwab does of its own ETF investors on its brokerage platform, it's really interesting to see that as you go from boomers to Gen X to millennials and beyond, younger generations of investors are effectively ETF native, no different than my daughters 14 and 11 are tech native and expect every screen to be a touch screen. So I think this is a trend that will only continue over time, especially with the net new dollars that are coming. And that's in addition to dollars that are opportunistically shifting from one vehicle to another.
One other item I have to ask you about while we're talking big picture here and some of the secular trends that are in place is this tweet that you had last week, which I thought contained an absolutely ridiculous stat. And that was that over the past 10 years, this is almost hard to believe, BlackRock and Vanguard have combined net inflows of $3.8 trillion. And that's into both their mutual funds and ETFs. And you said every other fund manager combined has seen $33 billion in outflows. That's just a wild stat. I'd love to have you offer some color around that because, again, I think that fits into some of these bigger picture trends we're talking about here.
Yeah, I think that's evidence of any number of things. And I think if you double click on that too, Nate, more recently I shared that if you look at all of the fund providers that are represented in that data set, it was actually a 50-50 split between, I'll call it haves and have-nots. So 50% roughly of the fund providers represented in that sample saw positive inflows on a cumulative basis over the prior decade. The other half saw cumulative outflows over that same span. I think what's most notable, as you alluded to, is that two of the funds within that sample that had positive inflows represented 46% of that cumulative number of cumulative inflows, which is really pretty dramatic. And I think that's evidence of the secular growth story, the success of the ETF wrapper, the growth of indexing at large, and just broad-based, bulk, plain vanilla, dirt cheap index exposures. Also the growth of model portfolios, which I think we talk about kind of here and there at the margin, but it's important not to discount just how dramatic an impact that model portfolios of all forms, be they provided by the asset managers, the ETF sponsors, be they managed at, say, the office of the CIO in a large wealth platform, models are driving flows. If you look back even just this year in their second quarter earnings commentary, BlackRock remarked that model portfolios, be it their own or third-party models, were driving more than 50% of net new flow into iShares ETFs. So all of these things really are representative of the fact that many investors, and I think advisors in particular, want to do more business, want to do a broader sort of span of business with fewer and fewer trusted providers. So that's really disproportionately benefited those providers that already have scale, that already have a full suite, a full offering with which that they can build their own fully proprietary models, fit into third-party models, and ultimately offer broader support, not just with respect to portfolio construction, but also dig in on things like practice management and all sorts of other topics that are sort of, for more and more advisors, going further and further up their list every day as they're increasingly getting out of the business of trying to beat the market, be the next Peter Lynch for their clients, and really just manage their books of business in a way that is efficient and effective as possible for the clients they're serving.
Yeah, it's such a great point on the model portfolios, and I think you would agree they're going to continue to be an even bigger driver. We'll stick to the ETF space of ETF inflows moving forward. We saw a number of examples this year of ETFs that I would say would sort of came out of nowhere, and you saw their assets jump significantly, and that was because they were used in model portfolios. I don't think people necessarily have a full appreciation for how big of a driver that is in the ETF space. While we're still on the topic of ETF flows, let's dive a little bit deeper into the flow data here in 2025. And I'm just curious if there are any major trends that jump out to you this year. I keep coming back to the obvious one, which is that investors continue plowing money into S&P 500 ETFs, NASDAQ 100 ETFs, products like VTI, basically all of the largest market cap weighted US ETFs. If we put that aside, because I think that's the obvious trend, do you see any other major trends beyond that?
Yeah, 8 years in now, Nate, you know that I'm going to try to lead with the boring, right? That the stuff that's every bit as exciting as watching grass grow and paint dry at the same time is where most of the action is. But if you dig a few layers deeper, and not even that deep, there's some really interesting trends to unpack this year. I think the other secular growth story we're seeing is active ETFs. Active ETFs by count now outnumber index ETFs. Active ETFs this year, those nearly 1,100 new launches, accounted for over 85% of net new launches. They've accounted for roughly a third of overall flows into ETFs this year. So if you want to point at any one subcategory that has helped ETFs get up over last year's record flows, I would argue that active ETFs deserve a lot of the credit for pushing those figures ever higher. And that's really, I think, just emblematic of just this shift we've seen with respect to packaging of active strategies. I mean, you know full well, Nate, you've been around this industry long enough to remember every time active ETFs would come up, someone would inevitably ask the question, well, isn't that an oxymoron? Can you really have an active ETF? Because the category was synonymous with indexing. And I think what we're seeing now is evidence finally of a recognition of just the ETF as a package. The analogy I use here oftentimes is Heinz ketchup, right? Very few people are buying Heinz ketchup in that old-fashioned glass bottle these days because it's kind of a pain to get all of your ketchup under that thing. I forget what the exact angle is you have to hold it at and where you have to hit it to get that last bit of ketchup out of there. The generational preference, the shift in packaging for Heinz 57 is towards the topsy-turvy, squeezy plastic ketchup bottle. And ETFs are that topsy-turvy plastic squeezy ketchup bottle. Same content oftentimes, just a package, a wrapper that's more convenient, more efficient, increasingly preferred by the end consumer. So active ETFs have had a tremendous impact on shifting the overall landscape and certainly played a role in now what's effectively become kind of like a train track switch for new flows, whereby many investors, especially those where it's a like for like, a so-called clone of an active mutual fund, simply prefer to consume that same content in the more modern packaging.
I like the glass ketchup bottle, by the way. Anytime I go to like an old school, the old school diners you go to and they have them sitting on the table, I love that. Okay, so active ETFs. I actually have a couple of follow-up questions for you on that, but any other major trends, and then we can circle back to active ETFs.
Yeah, so two other ones, if you just look kind of a layer or two below, Nate, the other one that is another just tremendous secular growth story is what we're seeing in fixed income ETFs. So as of last Friday, I counted $399 billion in year-to-date flows into fixed income ETFs. That's well above last year's annual record, which was $295 billion. I don't think people can ever adequately or fully appreciate just the transformational impact wrapping up bundles of bonds into an equity instrument has had for the underlying fixed income markets. So while certainly allocators have benefited and there's some overlap in the Venn diagram and the growth we've seen in active ETFs and fixed income ETFs, because if you double click on that, ultra short bond ETFs, actively managed ones, core bonds in both the core and core plus Morningstar categories have seen significant growth this year, but just fixed income ETFs broadly is a category, a record year, and I think just part of a just tremendous long-term growth story that's had benefits for investors that I don't think we'll probably ever be able to adequately measure. The final of the three sub-trends I want to touch on quickly, Nate, is just everything we're seeing with respect to derivative income and defined outcome ETFs. So this is a category that's emerged as part of another sort of secular growth trend. So if you look at derivative income ETFs, we've seen 56 billion in year-to-date flows. That's more than 55% higher than the record flows they notched in 2024. Defined outcome ETFs, where we've seen very significant news, certainly for our industry, just in recent weeks, with Goldman Sachs Asset Management stepping in and acquiring Innovator, one of the pioneers in this space. This category's seen 12 billion in year-to-date flows. That's a record year, and it's the highest flows count that category's seen since the terrible, horrible, no good, very bad year that was 2022 for investors. So really interesting trends there, trends that I fully expect will continue, largely based on the fact that the way that these funds either shape outcomes or enhance income just fundamentally answer all important investor questions around, am I going to be okay? Can I sleep at night? Am I going to have enough income to fund my way through retirement? You name it. They might not be the absolute best products. There may be costs, both explicit and implicit, involved, but clearly what we're seeing is that many investors are gravitating towards these funds.
Okay, so let me ask you a few follow-ups on each of those three trends. So you mentioned active ETFs, fixed income ETFs, and options-based or derivatives ETFs, which I would agree. If you look at the flow data, those three certainly jump out. And regarding active ETFs, you may have heard this, but I have a take that as more active mutual funds offer an ETF share class, which by the way, let's definitely talk more about the multi-share class structure because I know that's near and dear to your heart. You have followed that as closely as anyone. But my take is simply that it's going to be even more difficult for investors to differentiate between a lot of the active ETFs that are out there. I think it's already somewhat of an issue. There's just a lot of product on the market, but investors are about to be absolutely inundated. And so I'm curious how you think about that from both an investor and an issuer perspective. I would think it's certainly good for Morningstar's business, but what about investors?
Yeah, there's just an absolute wash of product, right, Nate? And I think for many investors, this creates sort of the equivalent of like the candy store dilemma, where it's just like there's choice overload. What we've been working towards is really going back to my sort of Heinz ketchup analogy, is like, how do we identify like the product, the content, the investment strategy, and then from kind of an overall sort of catalog databasing perspective, identify all the different wrappers, all the different SKUs, if you will, via which investors can consume that same content. So that sort of primary identifier is a unique construct that we've built called strategy ID. So I can look at XYZ fixed income strategy and say, this is available to investors via these various share classes of mutual fund, maybe a standalone ETF, maybe one day soon an ETF that's a share class of that mutual fund. It may also be available in, say, a separate account. So I think increasingly what we're seeing is that more and more participants in this space are reorienting around sort of the strategy first, and then looking at delivery mechanisms, looking at the individual fund or share class options second. And I think as we see ETF share classes on the horizon, that's only going to, in all likelihood, accelerate that trend. I want to decide on like what is my objective and who's going to help me meet that objective first, thinking about the content, and then we can talk about delivery second.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR. When it comes to active fixed income, AllianceBernstein leads the way. With AB's systematic fixed income ETFs, the AB Core Plus Bond ETF ticker CPLS, and the AB Corporate Bond ETF ticker EYEG, advisors gain access to Core Plus and investment-grade bond exposure backed by cutting-edge proprietary technology. These ETFs combine deep research with risk-aware strategies to help you navigate today's markets confidently. If you're ready to enhance your bond allocations with solutions built for the future, explore CPLS and EYEG from AB. Visit abfunds.com/go/ETFs to learn more. Investing in securities involves risk and there is no guarantee of principal. Investors should consider the investment objectives, risks, charges, and expenses of the fund/portfolio carefully before investing. For copies of our prospectus or summary prospectus, which contain this and other information, visit us online at www.alliancebernstein.com or contact your AB representative. Please read the prospectus and/or summary prospectus carefully before investing. CPLS and EYEG, distributed by Foresight Fund Services, LLC. Foresight is not affiliated with AB. Markets are always evolving. The Whole Tactical US ETF HTUS uses quantitative models to tactically adjust exposure to US equities on a daily basis. It's about adapting with discipline. Learn more about HTUS and how it can complement your investments at wholetacticalfunds.com. Carefully consider the fund's investment objectives, risk factors, charges, and expenses before investing. This and additional information can be found in the fund's prospectus, which can be obtained by visiting wholetacticalfunds.com. Read the prospectus carefully before investing. The fund is distributed by Northern Lights Distributors, LLC.
I don't want to get sidetracked here, but just while we are on the ETF share class topic, do you have any other hot takes you would offer on this? Again, this is something I know you have followed very closely. I've enjoyed all of your tweets out on X tracking this, but any other hot takes you would offer?
Yeah, I mean, I think my only hot take, Nate, is it's about time. This is something that in all likelihood, we should have done years ago more broadly outside, of a small town outside of Philadelphia, Pennsylvania. Granted, Vanguard had a patent on this structure for quite some time, and only recently has it lapsed, opening up a broader opportunity. But if you look at other markets around the world, you even just look north of the border in Canada, you look at the Australian market, ETF share classes have been a thing for quite some time. And really what it boils down to is giving investors choice and giving them optionality in a way that scales to the benefit of all investors of all classes of the fund. So we're finally getting on board there. I think in hindsight, SEC approval is going to prove to be the easiest part, believe it or not, of this whole process. There's a lot of work that has yet to be done with respect to just the plumbing to get these share classes to work in the way that investors want them to work. I think most importantly, to allow them to enjoy tax-free sort of in-kind transfers from mutual fund shares to ETF shares. And then there's a whole host of economic considerations throughout the ecosystem that have to be addressed as well with respect to sort of payment for shelf space and various forms of distribution economics, as well as just who's going to pay the bills to replumb the entirety of this system and the way it needs to be replumbed in order to get these ETF shares to work in the way that is going to deliver the greatest benefit for all investors.
Well, and to your point on the plumbing, I actually saw an article yesterday from Bloomberg's Katie Greifeld. You may have seen this, where she noted that market makers could come under some strain since they don't have unlimited capital, right, to devote to trading ETFs and seeding new ETF launches. And her point was this is just one of the many considerations that you were pointing out that could make this a little bit more difficult to bring the share classes to market than what maybe people think, or at least it's going to be a more cumbersome process. It's not like these issuers just hit a button and boom, they have an ETF share class up and running. So I do think that'll be an interesting story to watch, especially, again, as we head into next year. Okay, on fixed income ETFs, I'll just ask you a very basic follow-up question to the growth trends here, which would be that right now there's something like $7.5 or $8 trillion in money market mutual funds. And of course, we've seen the yields on those come down, right? The Fed's cut rates. We'll see what happens moving forward with inflation and whether the Fed, continues on a downward trajectory on rates. But let's just say that rates do continue coming down, at least, marginally. Do you think some of that money in the mutual fund money market vehicle could flow into fixed income ETFs? Could that be a catalyst where investors seek higher yields, or do you think that is overstated? I feel like I've heard a lot of people talk about, we'll call that cash on the sidelines. I don't know if it's going to come into the equity markets or crypto or whatever, but I do think fixed income ETFs could be a beneficiary. And as you know, there are now money market ETFs out there, which tend to be at a lower cost than the average money market mutual fund. So any thoughts around that?
Yeah, it's a great question, Nate, and it comes up all the time. I think first and foremost, it's important to take a step back. And while that, like 7 trillion figure now in money market funds is very large in absolute value terms, if you scale it as sort of using overall long-term fund assets as your denominator, as a percentage of long-term fund assets, it's actually well within historical norms. So the dollar figure is eye-catching, headline-grabbing, but really, I worry sometimes that we miss the script. It's like classic example of denominator blindness. So it's not necessarily at like a macro portfolio level that investors are parking proportionately any more cash on the sidelines than they have historically. It's just that absolute dollar figure is just absolutely massive. So that said, I think what you're seeing is that there's a variety of different competitive vectors here in terms of where are we going to get investors to park their cash in something that's cash-like or cash plus, if you will. So certainly if you look at the OGs of active ETFs, most of those ETFs dabble in sort of the short and ultra short-term bond space. So you look at the JPSTs, the mints of the world. These are products that were built for a variety of reasons. It was a good way to get your toe in the water in active ETFs. You didn't have to worry about daily transparency. There was all this swirling money market reform going on. So if we're going to dabble in ETFs, let's launch an ultra short-term bond fund. And what you've seen is that category has seen tremendous growth as more and more advisors are using that oftentimes as a money market substitute. In some cases, they're maybe getting a little bit of uptick in yield vis-a-vis what they might get in a traditional money market. More recently, ETF innovation has brought us into the moment where we've now got a handful of money market ETFs. So money market ETFs, interesting emerging category. From an ease of use perspective, are they quite as easy to use as traditional money markets? I'm not convinced, frankly. And then further along the frontier, what we're seeing is the emergence of experimentation in tokenized money market-like products. So the options now available to investors are greater than they've ever been before. They're expanding across a number of different dimensions, a number of different strategies, and also now sort of investment vehicles and delivery mechanisms. So I think the long-term answers are very far out there. There's a lot of, I think, just sort of institutional inertia in the money market space. People are used to using these funds in a very specific way. But that's not to say that we aren't going to see incremental dollars begin to go into other things, as we've already seen in the active ETF space among those OGs that I described before, that have grown, I would argue, in large part, in part at the expense of traditional money market funds.
Yeah, but I think your initial point is probably the best one with the denominator blindness, which I have certainly been known to experience from time to time. I think that's a good point. You you have to scale it and look at it on a relative basis. It just, that is a big number. You do have yields coming down, so it just seems like that could be an obvious catalyst. But to your point, if you look at it as a percentage of overall assets, maybe not as big of a story as it gets made out to be. Okay, real quick, the last trend that you had mentioned was the growth of options-based or derivatives-based ETFs. And I think this has also been a really big point of discussion this year in the industry. Just given how many new ETFs coming to market do hold options or other derivatives or offer some form of leverage. And of course, there are ETFs that do both. They have both, an income component and leverage. But the point is just the growing complexity and I would say growing riskiness of products coming to market. Do you have any big thoughts around that topic? Again, I've seen a lot of our counterparts or colleagues in the industry debate this. I haven't heard your take yet, though.
Yeah, Nate, it's a category that I think the risk here is that we paint it with an overly broad brushstroke because it encompasses a whole host of strategies that are fundamentally sort of thoughtful and sound and well constructed. And if you look at, certainly the category kings, if you will, in the JEPs and JEPQs, I would place them squarely in that category. Thoughtfully constructed, prudent, repeatable, scalable, clearly benefiting for all of those reasons and more. And then you have this emergence of, funds that I would place in a category I described earlier as, frankly, dumb funds. So single stock products that are writing options income, in many cases delivering some increment of income, but more often than not, returning a fair bit of investors' own capital straight back to them in a manner that is horribly tax inefficient. So there's this emerging category of, I'll call them dumb funds, or I think I've previously referred to them as kind of like the George Costanza category of ETFs. So everything they do, investors actually are probably best off doing the opposite. So they might be overly narrow, focusing on a single stock. They might introduce leverage. They might be very expensive from a fee perspective. They might be very tax inefficient. This is all the opposite of what investors love and have come to expect from the ETF category. And there's been tremendous growth in this sort of new and emerging subcategory of, call them dumb funds, call them Costanza funds, what you will. And in many cases, what we've seen is that unwittingly, the investors are signing up for something that frankly, they're just not getting. And we've seen this movie before in the past around the global financial crisis with leverage and inverse products. We know how it ends, which is for the unwitting, generally not with good outcomes. So I really do worry that first and foremost, we're painting this category with an overbroad brushstroke, and that we really need to focus on kind of this fringe that's emerged and equipping investors to go in eyes wide open. And frankly, in most cases, a lot of these products just belong in most people's too hard pile.
So Ben, I'm going to need Morningstar to introduce a new ratings category, the George Costanza ratings category. I want to see that when I log in, and you have a separate bucket. You can have the star ratings and the metal ratings, and then we'll have a George Costanza rating as well that you can dump some of those products into.
I'm going to get right to work on it as soon as we sign off today, Nate.
All right. Before we get into our usual year-end questions, two other flow topics I want to ask you about. And one, I've noticed you haven't brought this up yet, Ben, and that's crypto ETF. So big shocker. Let me bring that up for us. I'm sure you're absolutely floored that I'm broaching this topic, but let me give you a few quick numbers here. So spot Bitcoin ETFs, they have taken in something like $23 billion this year. Spot Ether ETFs, close to $11 billion. And then if you look at spot XRP and spot Solana ETFs and some of the other altcoin ETFs that have come out over the past month or so, that's around another $3 billion in assets. And so while crypto itself has not performed great this year, these products have continued to take in money. And then as you know, you go look at these filings with the SEC. I mean, there are a boatload of crypto ETF filings out there. I think I saw James Seyffert from Bloomberg said something like 125 crypto ETFs and registration with the SEC. So any thoughts you would offer around the crypto ETF category?
Yeah, I mean, it's a first and foremost, Nate, just amazing to me how far we've come from a moment where the industry effectively had to sue the Securities and Exchange Commission to have these products see the light of day to the moment where we stand today. And James's number is the best number, the most reliable number out there, where we've got a product pipeline that is absolutely chock a block with a whole host of things, including a filing for a Pudgy Penguins ETF. So I think what we're talking about is just really night and day, certainly with respect to the regulatory environment. And what you're seeing is that a lot of issuers are just trying to make hay while the sun's shining. While the regulatory environment is favorable, they're trying to push as much product out there to market as they can. But what we've seen, and I think certainly what most expected, is that most of the money is coalesced around, call it the blue chip products in this space. So IBIT in particular has basically become beta for Bitcoin and continue to see significant growth this year, significant flows, as you alluded to, despite the fact that performance, Bitcoin is, we sit here in this moment, is underperforming T-bills in 2025, which, I would personally never have guessed that if you asked me last we were together this time last year. Especially in light of the flows, the broader adoption that we've seen. But I do think ultimately what you're seeing is an artifact of just that packaging preference, Nate, that, especially I think a long time of sort of like crypto native investors realize that, owning these assets in, a centrally stored, very safe, very liquid instrument that also has like a whole ecosystem that's grown up around it with things like options on the ETFs, for example, is far preferable to the old days of. I remember anecdotes about cold storage, whereby your key was on a laptop that was wrapped in Saran wrap that you splattered with nail polish and threw in a vault somewhere deep underground. Like one of those options is I think far preferable to the other. What's interesting to me is that if you look back at 2024, I wonder, looking 5 years out, do we look back and say 2024, I'm going to channel, a series of Geico commercials here. Was that the year that crypto became its parents? That mainlining this asset class via this mechanism, begin to kind of take some of the magic out of the asset class with respect to returns, levels of volatility, correlations. It's too soon to tell, but historically the pattern has been anytime you take something from trading on an exchange named after Magic the Gathering to trading on the NYSE, more and more capital follows that asset. It becomes more and more institutional. You lose a little bit of that magic, that wild spirit that made it what it was to begin with.
I think that's certainly a valid take. I also think that just gets into the mainstreaming of crypto overall. And, as an example, you mentioned earlier, tokenized money market funds. I mean, we saw yesterday JP Morgan's launching a tokenized money market fund, seeding it with 100 million. My point is that I think you're seeing a lot of institutional players come into the space overall and the crypto overall. And I think we're, over the next several years, going to undergo a transformation to where you're going to see a lot more assets trading via a tokenized manner. And all of this just plays into, if you want to call it the institutionalization of crypto, et cetera, I think crypto has gone from something that was, rogue outside the system, it's going to slowly morph into the system. And so we can certainly debate whether that's good or bad or what that means from an investment perspective. But I think that's what we're seeing, and certainly ETFs have played a role in that, just in the institutional adoption and getting investors comfortable with it. Okay, enough crypto. The other topic I'll ask you about real quick is private assets and ETFs, which I remember when you were on here last year, we talked about this. And if I recall correctly, I think we both were somewhat skeptical or fairly skeptical on this category overall. And if you look at investor demand into the products we currently have on the market, not great, nothing earth shattering. And so do you have any new thoughts around private assets and ETFs now that we do have a few products out there?
Yeah, I mean, I don't know last year, Nate, if I approach this using my Goldilocks analogy, but I think of it like largely in terms of a match between sort of the liquidity profile of the delivery mechanism and the content of the bowl of porridge. So there's the bowls, the delivery mechanism, and then there's the content. And I think what you're seeing is that more and more investors and advisors in particular are coalescing around that middle bowl of porridge, which shows up in the semi-liquid space, and most notably in ticker traded products like interval funds, especially, that are just fundamentally very compatible with the way that they do business, that they invest in markets on their clients' behalf. Fun fact, interval funds were born in 1993, just 3 months after ETFs. So April 1993 was interval funds' birthday. They didn't really catch on until more recently, as we've seen this push to deliver more and more private markets exposures into intermediaries' portfolios, the portfolios they're building for their individual clients. So I think that's where you're seeing the right match between a level of liquidity, and granted, it's intermittent liquidity. So generally 5% a quarter. If it sees demand for more than 5%, you're going to get prorated. This creates some challenges and certainly is fundamentally different than the experience you have with ETFs. But what that intermittent liquidity allows is for a healthy sort of helping of actual private markets exposure. So in many cases, and especially in the fastest flowing current private credit, you're getting a full dose, a full bowl of private credit exposure. Whereas if you move over to the other bowl, which is traditional drawdown funds, that's too much for a lot of investors with respect to less liquidity, J curves, all of these various things that they don't want to have to deal with, a lot of paperwork that they'd rather not deal with, like K1s. And then if you go to ETFs, ETFs, I think, are kind of the too cold bowl of porridge in this current moment. So what you're dealing with more so than anything is just a very small increment of actual private markets exposure in the products that are out there today. And that really just hasn't proven as yet compelling enough for investors to kind of dig in and take a bite. Now, I stress that this is as we sit here today. ETFs and ETF innovation have been discounted time and time again. There was a period of time where we thought fixed income ETFs were absolutely, bridged too far. And then that went from fixed income ETFs at large to high yield ETFs to, in 2011, when BKLN launched, bank loan ETFs. I remember sitting across the table from representatives of PowerShares in 2011 and saying, these things trade once a month by appointment historically. Like, how can you get that to work in an ETF? And in all of those cases, what we've seen is that the ETF has actually kind of forced the underlying markets to grow up, to become more efficient, to become more liquid, to become more transparent. So too soon right now from where we sit today to say whether or not that might be the case for certain select subsets of private markets. I think private credit would be the most natural fit. I think venture capital is probably a not now, not ever sub-asset class for something like an ETF, at least to the degree to which investors might want it.
I think that's a really strong take overall, and I don't disagree with anything you said there. If I were to boil it down, the two prongs here, as much as you and I are champions of the ETF wrapper, I think we would both agree that maybe it's not the best vehicle or the best wrapper for every single type of investment. And that very well may be the case here. On the other hand, as you were saying, we know historically that you get that ETF ecosystem shining a light in opaque areas of the market that can be beneficial. And maybe that'll be the case here with private assets, that you get market makers and APs and the entire ETF. You have to figure out valuations and all those sorts of things, shining that light on the private asset space. There may be some benefit there for investors. So I think it can be both, and I agree. It remains to be seen how this will play out. But I thought this would be a 2025 story. It looks like maybe more of a 2026 story that's still unfolding. Okay, let's get to what is always my favorite part of this episode, which is I call these our annual rapid fire questions. If you want to bat these around a little bit, that's fine too. We can see where we go with these. And I should note for listeners, I actually snuck in a few new questions this year as well. So Ben, as usual, I'll tee up the question. You give me your your answer. And again, we'll see what happens here. So let's start with your ETF story of 2025. And if it's something that we already have discussed, that's perfectly fine. But what would you say is the biggest or most important ETF story this year?
Yeah, Nate, I think it's going to be, in hindsight, the ETF story of the year, which is ETF as a share class, which we already touched on. We now, as of yesterday, Cohen and Steers actually just filed for exemptive relief to offer ETF shares of its mutual funds and or vice versa. 91 filers in total. Now, not all of those 91 filers are necessarily immediately serious and ambitious in this space, but they're creating optionality for themselves. And I think when we look at this story 5 years hence, we'll realize that this is the moment where investors finally recognize, like, ETFs, are no longer a thing per se, that they've actually legally always been mutual funds. And ultimately what we've created is a new package that's increasingly the preferred one, and new sort of means by which investors can arrive in that preferred packaging by appending ETF shares to existing mutual funds. So still a lot of work to be done there, but I think certainly 5 years out, if we were to look back on this year, I think ETF as a share class would be the story of the year.
Okay, no arguments for me. I think there's some other stories you could look at. We could talk about the Triple Crown that we discussed earlier. You could talk about the flows into the Vanguard S&P 500 ETF. Last I checked, something like 165 billion. We had the crypto ETF sort of regulatory shift we've seen this year. I think that's been a big story, but tough to argue that the ETF share class, it's a big stake in the ground that I think you're right. We will look back on 5 years from now and say that was clearly an important story, perhaps the most important story of 2025. Okay, what is an ETF story this year that you were surprised did not get more attention? So, we just talked about something like private assets and ETFs, which I feel like got outsized media attention, at least from the media side. But what's a story that you feel like did not receive enough attention?
Yeah, under the radar, but also happening at the very top of the pile is what's going on right now, which is the fight for ETF supremacy between BlackRock and Vanguard in the US. So BlackRock's market share lead over Vanguard has continued to narrow over the years. Last I looked at it, and I got this to the nearest second decimal place, Nate, BlackRock at 29.65% market share versus Vanguard at 29.01%. So it's getting very close. It's very interesting to see these two go toe to toe, especially now as we're in a moment where there's been a change in leadership at Vanguard, and Salim Ramji taking the helm of the Vanguard enterprise. What you've seen is that a lot of what they've been doing recently is aimed at becoming more directly and immediately competitive with Salim's former employer in BlackRock. So that competition ultimately, I think, is interesting to me, because over the long history of the ETF market and just the asset management industry in general, it's yielded countless benefits to the end investor. So watching behemoths fight is fun to the extent that we all win at the end of the day.
It has felt for several years like it's inevitable that Vanguard is going to surpass BlackRock. I wonder if BlackRock's embrace of, say, an asset class like crypto, which I know in the whole scheme of things, even though it's grown significantly, it's still small, but BlackRock has shown to be a little bit more open to embracing some areas of the market like that. And I wonder if that's the one way they can fend off Vanguard, who always has taken a little bit more of a conservative approach. But again, you look at flows into products like VU and VTI, and it's just tough to say that Vanguard's not going to surpass BlackRock, maybe fairly soon here as well. But I like that. That's a good under the radar story. If and when that happens, I think that'll certainly get a lot of media attention. It won't be under the radar anymore. Okay, next, give us your ETF of the year. So one ETF to rule them all in 2025.
Yeah, so I had one fund in mind, Nate, which was the one that's simply at the top of the pile in VOO. And as I was looking at it and looked more closely, I switched my vote to SPYM. So SPYM, sort of the younger sibling of the OG of all ETFs, SPY, now sitting at nearly 100 billion in assets and 33 billion in net new flows year to date. So just from an organic growth perspective, actually outgrowing VOO. And just as the fourth horse in a late entrant in the S&P 500 ETF race, I think it deserves special recognition because it's delivering on all of the core promises of the ETF, and the ETF wrapper, very cheekily is undercut its competition by a bip here or there on fees. So want to give a nod, want to give credit where credit's due to the State Street Investment Management team and the success they've had with SPYM.
I like that. That's a good one. Yeah, clocking in at 2 basis points. Actually underwent a ticker symbol change this year. Was SPLG, now is SPYM, as you mentioned. And it's funny because you may recall one of my predictions for 2025 was that either Vanguard or BlackRock, they would chop the fees on their S&P 500 ETFs to try to compete with SPYM, and they haven't done that. So I'm going to be wrong on that prediction, but good for SPYM. And I think we're going to continue to see that ETF take in cash. So that's a good one. I like that. All right, your favorite new ETF. So we talked about the 1,100 or so ETFs that have come to market this year. Do you have a favorite, one that stands out?
Yeah, buckle up here, Nate, and prepared to be bored stiff, because my favorite new ETF of 2025 is VBIL. So this is the Vanguard 0 to 3 month Treasury bill ETF. We're talking about
I'm already falling asleep here.
a staple of all staples. I've gone to the grocery store, I've bought a loaf of bread, and guess what? I'm paying less for that loaf of bread than any other loaf of bread in that staple space. I think, again, it's evidence of everything we know and love about ETFs, and the fact that there is still, even in the vanilla, some opportunity for established firms and also up and comers to continue to add value in very core, very evergreen exposures to the benefit of the end investor.
Like I said, I'm yawning here. Do you know what the assets are in that? By the way, I don't have it in front of me.
I want to say, Nate, top of my head, there's a few billion. It may be as much as 4 billion in AUM. So of all of the nearly 1,100 ETFs that have been launched this year, it's the largest. It ranks as the largest by AUM in that pile. Interesting too, Nate, when you look at those 1,100 ETFs, 85% of them, as of the end of last week, had less than 100 million in assets. So going back to my widely known spaghetti cannon analogy, a lot of the pasta that's been blasted on the wall this year is not going to stick. I think VBIL is going to be an exception to that rule.
Yeah, for sure. We always talk about how meticulous Vanguard is with new launches. And I think they've gotten a little bit more aggressive here. They're starting to roll out some active products or more active products. But it's amazing because they launched something like VBIL and boom, has a few billion in it. So to your point, that's a good but boring one, but I'll give it to you. Okay, a few more here. Give me your best new ETF ticker symbol, which is always a fun category.
So Nate, I need an assist from you here. In the moment, I can't remember the artist who is responsible for the song "You're So Vain." You probably think this song is about you, don't you? We'll come back to it in the show notes. And I bring that song up because this is probably the most vain choice I could have made for ticker of the year. My choice for ticker of the year is Ben J. So this is the Horizon Landmark ETF. Kind of an odd mix of treasuries plus options for 40 bips. Not necessarily a fund I think is super compelling. But I couldn't, being Ben Johnson, and with everything going on in the city of Chicago, as I discussed earlier, pass on Ben J. That said, in related, I want to give a shout out to the team at Barron. They just launched yesterday their first ever ETFs. The Barron First Principles ETF actually carries the ticker RONB. So Ron and his track record is the stuff of legend. So only fitting that his name is also the stuff of their new ETF ticker. And one more, because this is always so difficult for me, Nate. I have to give an honorable mention to our friend Matt Hugin and the team at Bitwise for the ticker BWOW, which is the ticker for their Doge ETF. I thought that was clever, and if anybody knows the importance of having good ticker game, it should be Matt and the Bitwise team.
Yeah, the crypto ETF space, there's some really nice tickers out there. I was looking through the list as well, and this isn't necessarily a crypto specific ETF, but the Yield Max strategy short option income ETF, the ticker on that is Winter, WNTR, like crypto winter. I thought that was pretty good. There's a lot of those out there, which again, I always appreciate. I always like the thought of ETF Issuer sitting around like a boardroom table, throwing ideas at the wall on tickers, and I'd love to be in some of those meetings. Okay, you mentioned Barron Capital coming to market yesterday. Favorite new ETF entrant this year? Would it be Barron or somebody else? We've had quite a few new players come into the space. Is there one that stands out to you?
Yeah, so this is one, Nate, where I'm going to do a little sort of an interpretive selection and say that I think advisors are the ETF issuer of the year. And when I say that, I mean specifically what we're seeing kind of at the bleeding edge of ETF innovation, and some of these new ETFs that have come to market via 351 exchanges, whereby advisors are seeding these ETFs with pre-existing client positions. So if you look at a pair of recent ETF launches from Alpha Architect in AAUS, AAQ, what Cambria has done, and Cambria launched the first such ETF this time last year with tax, more recently ENDW and GEW. These 5 ETFs that were all created by this 351 exchange mechanism today collectively hold nearly $1.3 billion in assets. So I just think it's an interesting artifact of kind of where we're pushing the boundaries of ETF innovation, and really, again, putting the advisor and their end client, their tax outcomes front and center. So I'll call that loosely advisors, but really it's jointly in honor. I'll hand over to the Alpha Architect and Cambria teams.
I love that. Advisors is the best new ETF issuers. That makes a lot of sense to me. And that's actually a prediction that I think I got right at the beginning of the year. I said 351 exchanges would go mainstream. That's exactly what we're seeing. And I think that's going to be, again, another big story next year as well. I think the direction there is only, up and steeply up. All right. Lastly, give me your ETF issuer of 2025.
Nate, I have to go with Vanguard. $421 billion in year-to-date flows. That represents nearly a third of overall ETF flows. We mentioned VU before is going to run away with the crown. 165 billion in year-to-date flows alone. It's so far ahead of the rest of the pack when you look at individual ETFs. They've launched 15 new ETFs this year. That's the most new ETF launches in any calendar year for Vanguard, going back to 2010. But they're not going wild. They're staying true to their roots. They're filling out some gaps, as I alluded to, with VBIL in their existing fixed income range. They're launching some new and interesting products in the active equity space. And what you're also seeing is that there's early signs of success among those 15 products. So 7 of those 15 already have more than 100 million in AUM. And the other interesting development at Vanguard is that they're seriously committing and doubling down, investing in their model portfolios business. So they're not just bringing these new products to market, but they're bringing new blueprints for their advisor clients as to how best to put all of these pieces together in the context of a diversified multi-asset portfolio. So Vanguard, I think, continuing to lead the charge, getting a little bit of its groove back is manifest in some of those numbers I've shared. I've got them as my pick for 2025 ETF Issuer of the Year.
Respectfully, I would say that is a very boring pick, but it's also a pick it's tough for me to argue.
Yeah.
I'll go with who I'm going to go with? Innovator ETFs. You know why? Because you mentioned earlier, $2 billion from Goldman Sachs. So Bruce Bond and team, they can go buy an island somewhere. and just enjoy the, although that's not his nature. Maybe he'll start up another ETF issuer, but I'll give it to Innovator, just getting $2 billion from Goldman Sachs. Okay, real quick. It's so funny. I said I'd give us, the full hour here because we always run short on time. And here we are now crossing over, an hour, which I love. This has been fun. But very briefly here, let's look ahead to 2026. And I'll just ask, maybe give me 2 or 3 ETF stories that you're going to be watching. Like what's most on your radar heading into next year?
Yeah, I think some of the stories we've covered pretty well already, Nate. ETF is a share class, and I think especially a lot of the plumbing work that's happening and some of the follow-on filings. So to date, we've really only seen dimensional formally filed prospectuses for 13 combinations of mutual funds and ETF shares. Eager to see who else is going to follow suit. There have been some fresh filings that have come in, updated 40 app filings from a number of issuers recently, but my guess is that the minority of the 91 that have filed are really going to follow through in earnest come 2026. So we keep paying close attention to that trend, as well as the other one we talked about, the push into private markets. So how far are issuers going to try to go with respect to both increasing sort of the proportion of, say, private credit in any given product and or pushing into new markets? We see some interesting products at the margins that are owning things like SpaceX in the case of XOVR. Will be interesting to keep tabs on what happens there, and also just more generally what we're going to see from an overarching regulatory point of view. The last one I'll throw out there, and it's kind of a wild card square, Nate, but it's not getting a lot of attention, a lot of oxygen, is just the Growth Act, and specifically the piece of the Growth Act that could potentially level the playing field with respect to tax treatment between mutual funds and ETFs. I mentioned earlier that the US market is kind of out of step with a lot of our global peers with respect to ETF as a share class. We're also out of step with respect to how we tax mutual fund shareholders. In most other markets, ETF's tax advantage is not a tax advantage at all because all fund shareholders are taxed effectively equivalently. So if the Growth Act were to level tax treatment between mutual fund shareholders and ETF shareholders, that could have some interesting impacts. I think mostly on mutual fund shareholders. I think it would manifest most prominently in more inertia, which we discussed at length before. But over a long enough period of time, I think the advantage would still tilt in ETF's favor for all of the reasons that we described and have internalized over the years we've been looking at these markets. I think ETFs ultimately are going to win the day over mutual funds over a long enough time horizon.
That's a good one. You're right. I haven't heard a lot of discussion around that. It does feel like every few years, and maybe it's with a political cycle, you'll see the taxation of ETFs becomes sort of a political football, comes back to the surface. So that'll be one to watch. Yeah, I think we did a good job on hitting on most of the trends that are going to be key in 2026 because it's a lot of the same ones from 2025 that are going to carry over into next year. So yeah, I would add 351 exchanges. Those will continue to be a hot topic. And then of course, I still think the crypto ETF topic will be a big one. I think the story next year on crypto ETFs with this 125 plus that will be coming to market is which ones will actually, survive. Right, there's already a lot of competition there, but there are only so many assets to go around. Some of these are very esoteric crypto assets. So how does that play out? I've said before I'm very bullish on crypto index-based ETFs just because of that. That if you have 125 plus and it'll grow coming to market, maybe advisors just say, you know what, I'm going to hit the easy button and buy a crypto index ETF. So I'm very bullish on that space, but I think that'd be another big story to watch as well. But Ben, this is always so much fun. I appreciate your time. I appreciate the way you cover the ETF space. So I hope you and your family have a wonderful holiday season and certainly look forward to seeing you next year. Will you be at Exchange in March?
Yeah, looking forward to the changing climate as it's been in the single digits here in Chicago the past few days. So sunny days in Vegas with all my ETF friends sounds very compelling right now, Nate. But before then, happy holidays to you and your family, and always appreciate the opportunity to join you and look back at the year that was this time of year.
Well, thank you. And hey, maybe you'll be wearing a Chicago Bears Super Bowl champion T-shirt in Vegas in March.
Yeah, I can hope. I don't want to get too far ahead of myself.
Hey, Ben, thank you very much.
Thanks so much, Nate.
That was Ben Johnson, Head of Client Solutions at Morningstar. That'll do it for this week's ETF Prime. Speaking of Exchange, again, I'm excited to tell you that I will be there, Exchange 2026, where I'll be taking the stage and even recording a live episode of this podcast. This is your chance to join me alongside a community of top advisors and industry experts, such as Ben, for a few days of world-class content and unparalleled networking. You can secure your spot today by visiting exchangeetf.com. Next week, I'll be joined by Brittany Christensen, Senior Vice President at Tidal Financial Group. We're going to spend some time going more in depth on the ETF share class structure story. And then Brittany will also give us her preview of ETFs in 2026. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, President of OTR Media, LLC. Nate is also President of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.